What's up guys, in today's video we're going to be talking all things tax implications on investing in shares over here in the UK. One of the core reasons for investing into the stock market is to obviously make some money. And whenever there is money to be made, you can almost guarantee that there is going to be a tax bill just around the corner. As the old saying goes, there's only two things that you can guarantee in life: death and taxes. And in this situation, it's certainly no different. So let's talk about things in a little bit more detail. But before I do so guys, at the top of the video, I did want to say that I am not a qualified tax advisor. All of the information in which I'm going to present to you guys in this video has been sourced from the gov.uk website, which I will leave all of the links to down in the description below. Now, before I dive into it, for those of you guys who are new around here, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys. It really helps out the channel. And with that being said, let's dive straight into it. Her Majesty's Revenue and Customs, the government organisation in which we all have to pay our fair share of taxes to. Now, this government organisation is so powerful that if you personally decide that you do not want to pay your taxes, Queen Liz will come and kick your door down and put you behind bars for a very long period of time. Now, obviously none of us want that to happen, and Queen Liz is knocking on in her later years right now, so the last thing that she wants is to be chasing all of you tax dodging criminals out there. So with that in mind, and all jokes aside, taxes are there for a reason, and we should all certainly look to pay them, not just to contribute to the future prosperity of the country, but more importantly so you don't actually run into any complications or any issues later down the road. So let's talk about the tax implications on shares, because there are three common tax types that you should all really know about. But towards the end of the video, I'm going to share with you guys one completely legitimate way to avoid paying all tax on all of the investments in which you've made over here in the UK. So be sure to stick around until the end of the video in order to get that information. So the first tax in which I want to talk about during this video is stamp duty. Now, stamp duty is a tax in which you've probably more formally heard of when you're actually looking to buy a residential property. And this type of stamp duty is called stamp duty land tax. But when you're investing into shares over here in the UK, there's a different type of stamp duty which you have to pay, which is called stamp duty reserve tax. Now, the stamp duty is charged automatically at 0.5% of the value of the transaction in which you're making. And very critically, it's only applicable to when you're actually investing into UK registered companies. So you can actually avoid paying the stamp duty tax if you do one of the following things. Number one, if you invest into a company that is not registered over here in the UK. You could look to invest in Apple, which is obviously a United States based company. However, do just bear in mind that different tax rates will apply to the different countries of the companies in which you're actually investing into. The second way is actually to invest into a mutual fund or an exchange traded fund, because the makeup of these funds are slightly different to actually investing into individual stocks and shares. So stamp duty, generally speaking, is something that you can't really avoid all that much, especially if your primary goal is to build up a portfolio of UK based companies. I guess you kind of just have to put it down as one of the costs of investing. The second type of tax in which you're going to want to be aware of is capital gains tax. Now, capital gains tax, as defined on the government website, is the tax on the profit when you look to sell or dispose of something, i.e. an asset, that's increased in value over time. So as an example, let's say I look to buy 100 shares in Unilever for £38 per share, making the total value of my investment £3,800. But then let's say 12 months from now, the value of those shares has increased to £50 per share, making the total value of my investment £5,000. Now, at this point in time, I may want to look to realise my gains and actually cash in the £1,200 profit in which I've made. So in order to do that, I sell those shares back to the market and cash in on that £1,200 and put that money back into my bank account. At this point in total, you've made capital gains to the tune of £1,200. Now, one of the questions in which you may be asking yourself, especially if you've dabbled in the stock market and managed to make some money, is do I need to actually pay tax on the gains in which I've made? Well, the answer in short is yes, but, and the big but, is only if you've actually made capital gains, realized capital gains, over and above that of the capital gains tax-free allowance. Now, that capital gains tax-free allowance is £12,300 per year as of recording this video in February 2021. To provide additional context on how this works, you're probably more familiar with the income tax-free allowance of £12,500, whereby, let's say if you earn a salary of £30,000 per year currently, the first £12,500 in which you earn is actually completely tax-free. This same kind of tax-free allowance applies arise when you look to dispose of your assets too. Now don't get me wrong, if you're absolutely balling out and you're making well over £12,300 per year in capital gains, you certainly will have to pay tax on anything over that. Now in terms of what those tax rates are, well, it's 10% tax if you are a basic rate taxpayer, or it's 20% if you are a higher or additional rate taxpayer. So like with anything, the more money that you make, the more money that you get taxed. The next tax to be aware of is something called dividend tax. Now simply put, a dividend is the distribution of a company's profits to all of its shareholders. If you own shares in a company that pays a dividend, this will be a monetary amount that you receive from the company either quarterly or on an annual basis. Now, as with capital gains, there is also a tax-free dividend allowance, quite luckily, of £2,000 per year as of currently recording this video. However, only about 3 or 4 years ago, that tax-free allowance was actually £5,000 in dividends until HMRC became a little bit more stingy. So for now, the dividend tax-free allowance stays at £2,000 per year, and that may change over the course of the coming years ahead. Now, just for perspective, in order to actually make and earn £2,000 per year in dividends, the chances are you've probably got a decent amount of cash invested into the stock market. Even if you're invested into a company that pays a 3% annual dividend yield, you'd need to have roughly £65,000 invested just to be earning £2,000 per year in dividends. But if you've got a big fat wedge of cash invested into the stock market and you're making more than £2,000 per year in dividends, here are the tax rates in which you need to follow. So if you're a basic rate taxpayer, the tax on dividends above that of £2,000 is 7.5%. If you're a higher rate taxpayer, it's 32.5%, and if you're an additional rate taxpayer, it's 38.1%. So hopefully all of you are still with me at this point, because it's a hell of a lot of information to take in. And hopefully none of you guys have managed to fall asleep just yet, because this is the really important part where I'm actually going to share with you guys how you can actually avoid paying as much tax as humanly possible. And the way in which to do this is to use a tax-free investing account, also known as a stocks and shares ISA. And as I quote from the government website itself, you do not pay tax on income, which means a dividend, or capital gains from investments in an ISA. Now, in my personal opinion, the stocks and shares ISA is the best tax wrapper which we have available to us over here in the UK. And the reason why I say that is, let's say you've used your stocks and shares ISA to invest over the course of the next 10, 15 and 20 years in order to retire early. If all of that money is held up in a stocks and shares ISA account, you don't need to pay any capital gains tax. Whereas, as I said before, if you're just using a general investment account which is liable for capital gains tax, you will potentially face quite a hefty tax bill on the hundreds of thousands of pounds, if not the millions of pounds, in which you've managed to compound over the years. Now, the only real downside to using a stocks and shares ISA is, I guess, two of the following things. Number one, you can only invest into one stocks and shares ISA per tax year. And number two, the maximum amount in which you can invest into that stocks and shares ISA is capped at £20,000 per year. But other than that, it's a perfectly legitimate way to avoid paying any kind of tax on any of the capital gains in which you've managed to make from investing into the stock market. So with that said, guys, there should be absolutely nothing to worry about, and the tax man should certainly not come kicking your door down for not having paid your tax, because you're not liable to do so if you're using a stocks and shares ISA. Now, what I would recommend, guys, is if you're unsure about absolutely anything, be sure to check out the links in the description to the gov.uk websites, along with contacting HMRC if you have any concerns whatsoever. With that said, guys, if you have any questions or video suggestions, be sure to leave them down in the comment section below. If you enjoyed the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.